what's a question listeners right now can ask their existing accountant to be able to identify if they're a historian or a planner or both?
Absolutely. One simple thing is, what have we done the last 3 years that have helped me reduce my taxes? What ideas have we put into place that has helped me reduce my taxes? And if they say, well, what do you mean? We're trying to help you. We categorize all the deductions for you. We make sure you're getting a write-off for your mileage on your car. If they're saying those kinds of things, checking boxes.
Yeah.
They should say something, and you should know. I mean, truthfully, you would know if your accountant is coming to you and saying, hey, Mike, based on the first quarter P&L, we're thinking you're going to have this kind of year. Why don't we think about this or that strategy and spend the next few months vetting it?
Yeah.
That's what you hear. But the questions I'd ask is just tell me what we've done in the last year, 2 years, 3 years through your guidance to reduce what I have to pay in taxes. And they should have some very specific answers and not just, well, we make sure you take the deductions, or we're taking a salary and then we're setting up an S Corp, you're getting a salary and you're getting a dividend. All that stuff's blocking and tackling. Should be stuff that's more advanced than that in their strategies.
What about stuff like what plans or ideas do you have for this upcoming year?
Even better, right? I love that question, is what can you do this year for me that we didn't do last year or the year before? And often they'll say, what do you mean? And if you get that deer in the headlights, you know that they probably are not tax planners.
Yeah, yeah.
And even you might say, here's another good question. This year we did 600,000, right? Your example. So if someone did 600,000, they go, what if we did 2 million?
Right.
What would you advise us? If our goal is to get to 2 million, what would you advise us differently than what you're advising us right now? And if it's not much, then that's someone who's not used to dealing with an entrepreneur who's really growing and has all this opportunity. And unfortunately, often entrepreneurs outgrow those accountants and don't realize it. And so they'll come to me and say, I've been paying all this taxes because I went from 600,000 to 2 million 3 years ago, and we're doing the same thing that we were doing when I was making 600,000. That's a huge missed opportunity. There are some times you can do revise your tax returns back years, 3 years back, but there's a lot of stuff you can't go back and change.
Yeah. So right off the top, let's say 500,000, 600,000. Let's say 600,000, they're doing about 15% net profit. So what would that be, like 90,000 net profit, right? What are some things that they can do, like some basic things that you think all fitness studio owners, small business owners can start looking at and saying, you could probably do something like this, like that, or that in order to help either defer or reduce taxes?
One thing is, if you're a sole prop, so you're not incorporated, you have a liability problem because your assets are now at risk. If your business gets sued, your personal assets can be at risk. So I would say, if you don't have an entity set up, think about setting up an entity.
Okay.
One thing you can do on income is you can do something called an S Corp, to where you have a reasonable salary paid and the rest is a dividend paid out from the company, so that reduces your taxes. That's a pretty simple thing to do. There's things about if you want to help an elderly parent or a child, how you can gift money. So if you have something like appreciated stock, you could gift it to a child, an adult child, rather than giving them money and then paying in your tax bracket first to give them the money. You could give them a stock, they could sell it. If a single person's under 40,000 of adjusted gross income, capital gains tax rate is 0, so that would be a 0 tax rate.
Wow.
Some other simple things that they can do, there's something called the Augusta Rule. And the Augusta Rule allows you to rent your home to anyone else for up to 14 days a year tax-free. So how does that work if you have a business? Well, if you have a business purpose, you can rent your house to your business for 14 days a year, and it's tax-free. So it's tax deductible to the business, tax-free to you as an individual. So that's
if you
a way.
wanted to host any type of events there, leadership retreats, or even just work there, or just work there.
Right.
I mean, that's
absolutely.
Yeah, that's really cool. So then you'd pay that, but then you'd get that money, that'd be something to write off.
Absolutely. So let's say it's, and I don't know what kind of house we'd be talking about, you'd want to get reasonable quotes and things like that. But let's say it was $2,000 a day, you did that for 10 days a year, that's $20,000. If you're in a 40% tax bracket, federal plus state, that just saved you $8,000 in taxes.
Because the money just went into your pocket.
That's right.
You paid yourself.
Right.
The only difference is you now get tax write-off on that, as opposed to you would have paid tax on that $20K.
That's correct.
That's so crazy.
But what a lot of people don't know is you still have to document it. So sometimes we meet people, they'll do an idea like this.
Yeah.
You have to document the business purpose. You have to have a lease agreement between you and your company. There's things you have to do to dot the I's and cross the T's. And that's why doing legal tax planning, even if it's legal, but you don't document it right, that can be a problem.
Yeah.
But that's an easy one that people could be doing a lot.